So see, when it comes to trading or even investing, psychology plays a great amount of role in it. You can say that 70% of investments or trading consists of psychology only. The other 30% consists of strategies and all, right? So when it comes to trading, especially trading, we all know about a book called The Intelligent Investor by Mr. Graham. Now, when it comes to trading, I prefer discipline over intelligence. Definitely, you need a certain level of intelligence, but trading requires discipline. Now, when it comes to a disciplined trader, that person should possess three qualities, basically three qualities, right? The first and the foremost, I must say, it is managing his behavior. Behavior management is of prime importance to a person's trading journey or investment journey. If you can't manage your behavior, it's futile to invest or even trade. Second point is managing your money. Money management becomes very much important if you choose trading or investing as a career, be it a part-time or a full-time, right? The third important thing is method, or you can say strategies, right? Now, when it comes to trading as a whole or even investing, these are the few mental aspects, or you can say the intangibles that every trader or investor faces. The first one, lack of discipline. If you don't have the required amount of discipline, if you are indisciplined in life, trust me, you won't succeed. That's a clear indication that you don't have the willpower to succeed in life, right? When it comes to the second point, that is euphoria, we all suffer from FOMO, that is fear of missing out. If someone, Mr. X, takes a trade or invests in a company, then that doesn't mean you also need to trade or you also need to invest in that particular company, right? Third point is fear. Yes, we all get frightened, but that doesn't mean that we don't need to overcome our fears. A person who has the determination, who has the willpower to overcome his or her fears, I'm sure that person will succeed. When it comes to the fourth point, it is doubt. Most importantly, self-doubt. If you have self-doubt, that's primarily the main reason why one doesn't succeed in trading or investing or on a macro scale, even in his life, right? So one should not have any self-doubt when it comes to life as well as when it comes to trading. If you have a system, just go ahead and implement that system with proper risk to reward ratios and other stuffs. The next is hope. Always be optimistic. Always be optimistic, but that optimism must be realistic. Like in case of your investments or trading, your hope or your optimism shouldn't be like you'll earn 70%, 80% in a year. That's an unrealistic expectation, right? So you have to set that particular expectation, that level, right? The next is regret. Never, ever, ever regret your decisions. Please think about your decisions before implementing. But once you have implemented, then please, please, please don't regret. The second last point is frustration. We human beings, we all become frustrated at some point of time, right? But if you are frustrated, you are in that particular phase, then it's my request that please don't take a trade or don't invest in that particular phase. The last point is greed. Definitely, you must be greedy, but that must be there when the scenario is conducive enough. What I mean is, let's say the market is in a bull run. You shouldn't be greedy in that particular phase. When you are in the bear market, because see, nobody can predict the bottom as well as the top of the market. So when you are there at the in the bear market, I must say, then you must be greedy and you must have that much capital to deploy in the market, right? Now, when it comes to trading as a profession, there are some truths. Many people talk about myths, but I'll talk about the truths. Now, when it comes to trading, primarily there are two things. And when you earn your profits, it's just a function of these two things only. These two things are hit rate, and the next one is the risks to reward ratio. Now, hit rate is how many times you are correct in your trade. Let's say if you are correct 6 times out of the 10 trades you took, so that's your hit rate, 6 out of 10. When it comes to risk reward ratio, it's of prime importance. If you don't have a risk reward ratio in place before you place a trade, trust me, you are not trading, you're gambling. That's the harsher truth, right? So always keep these two things in mind before placing a trade. Now, when it comes to psychology, I often discuss this with my students that the Sholay movement, Sholay, as you all know, is a famous Bollywood movie. Now, while playing this game, let's say the game is like that. If I toss a coin, and if your prediction becomes correct, then I'll pay twice the amount that you have bet. Let's say, to make things simpler, let's say if you have bet rupees 5, if your prediction becomes successful, then I'll pay you 10 rupees. But if your prediction is incorrect, then you'll pay me 50 rupees. Now, what I ask is, would you like to play this game? Would you like to play this game? Rationally, the answer will be no, because the risk reward ratio is Not at all in your field, right? If you're right, then you get twice the amount that you have bet. But if your answer is incorrect, or if your prediction is incorrect, then you lose 10 times of what you have bet, right? Now every trade has basically two decisions. We need to make two decisions. Number one, whether we should go long or short. Long means that we are bullish about the market or a particular stock, and short means we are bearish about the particular stock or even the broader market. Now, the main thing is what percentage of your capital are you willing to risk on any particular trade? You can see here that, let's say, if you have 110 rupees note, or you can 10 rupees coins in a particular jar, and this is your trading capital, right? Now, how much percent of your trading capital are you willing to invest in a particular share or on a particular index? You have to make that decision. If you don't apply your brains in these two decisions, trust me, sooner or later, your trading career will come to an end. And that's the reality. That's the reality. Now, this is particular, I love this particular slide, you can say, that this is a probabilities matrix, right? Now, what you can see here is 50-50, 66-34, and 80-20, right? So these are the scenarios between the hit rate and the poor luck. In case of 50-50, 50 times, that means half of the time you are correct, your prediction is correct, and half of the time your prediction is incorrect. Same goes with 66-34, 66 times you are successful, 60, and 34 is your particular rate of unsuccessful attempts. Likewise, 80-20. Now, in case of these scenarios, if you see here, this is the first one, this is the second one, this is the third one, and this is the fourth one. Now, if you take one incorrect trade with this particular ratios, you can see if you are 80% of times you are correct and 20% of times you are incorrect, then the probability is 1/5 after one unsuccessful attempt or trade. But when it comes to 4 consequent trades or consecutive trades, you can say, then if your particular hit percentage or poor luck ratio is 80-20, then just see this probability. It is 1 out of 625. That's too much, too much, too much. So if you consistently make 4 bad trades, trust me, it can wipe out your trading capital. It has that potential, right? Now, I completely enjoyed this particular session while teaching you all this. This might be a new thing for the beginners and the pros, those who are in the market for more than 5, 10, 15 years. I guess this particular session will be a revision class for them. Thank you so much, and I'll definitely meet you in our next session, and I hope that will be on some basics of investing. Thank you so much.